Speculation has swept across the global financial landscape as investors, analysts, and ordinary currency holders react to reports of a sudden revaluation of both the Iraqi dinar and the Vietnamese dong. While the official confirmations remain absent, the very idea that two emerging market currencies could undergo a dramatic revaluation simultaneously has sent shockwaves through foreign exchange circles, commodity markets, and even retail investor communities online. The Iraqi dinar, which has long been tied to speculative conversations about revaluation, is once again at the forefront of international discourse. But what makes this moment particularly striking is the parallel discussion around the Vietnamese dong. The two currencies together represent more than just local economies. They are symbols of how global markets respond when whispers of currency reform, policy shifts, and economic restructuring collide with speculation and demand. The surge of attention began after leaks and informal reports hinted that the dong was appearing on certain exchange listings at a value dramatically higher than its historical range. One figure that circulated widely was around 4.78 per unit, a rate that, if true, would fundamentally alter Vietnam's role in international trade and investment. At nearly the same time, the Iraqi dinar was said to be preparing for a similar recalibration. For years, the dinar has attracted attention from international investors who have viewed it as a currency artificially undervalued due to decades of sanctions, conflict, and economic instability. The new wave of speculation suggests that Baghdad may be preparing to reposition the dinar in line with its oil export capacity and its aspirations to reassert itself as a regional financial hub. Markets, however, thrive on more than rumors. They react instantly to sentiment, and that is exactly what we are witnessing. Trading forums, online brokerages, and private investor groups are ablaze with discussions of how to position portfolios in anticipation of a potential windfall. Some investors believe this could mark the single greatest wealth-shifting event of the decade, while others warn of a repeat of past speculative bubbles that ended in losses when no official confirmation followed. Nonetheless, the psychological impact of these reports has already been felt. Emerging market bonds, commodities linked to Iraq and Vietnam, and even secondary currencies in the region have seen short-term fluctuations as speculators attempt to predict the fallout. At the core of this surge is the belief that both countries have strong incentives to pursue currency revaluation. Vietnam has steadily grown into a manufacturing powerhouse, attracting foreign direct investment as supply chains diversify away from China. Its trade balance, foreign currency reserves, and role in regional trade agreements all lend support to the idea that the dong could one day appreciate significantly. Iraq, on the other hand, possesses one of the largest proven oil reserves in the world and has slowly stabilized governance structures since the turbulent years of conflict. A stronger dinar would not only increase national purchasing power, but also potentially give Iraq more leverage in pricing its oil and engaging in regional trade agreements. For investors who view currencies as reflections of underlying economic strength, the rumors strike a chord of plausibility, even if the scale of the reported values remains questionable. But beyond the allure of potential profit lies a significant degree of risk. Historically, the Iraqi dinar has been surrounded by false promises of overnight revaluation, leading to regulatory warnings and investor losses. Numerous scams have flourished around the dinar, with sellers persuading unwary buyers that massive appreciation was imminent. In reality, currency reforms are complex, requiring alignment of fiscal policy, foreign reserves, debt structures, and international partnerships. Even if Iraq or Vietnam were to announce new valuations, the accessibility of those rates to everyday investors remains uncertain. Central banks often set strict controls on how revalued currencies are distributed and exchanged, and large institutions usually benefit before the retail market ever sees an effect. The present situation also highlights the delicate balance between speculation and stability. On one hand, rumors of revaluation invite optimism and capital inflows, which can benefit economies looking to attract attention and investment. On the other hand, uncontrolled speculation can destabilize local markets, fuel inflationary pressures, and create disparities between the official exchange rate and black market valuations. Both Iraq and Vietnam would need to carefully manage such transitions to avoid the pitfalls that have plagued other nations attempting abrupt monetary adjustments. Global financial institutions are monitoring the developments closely. If Iraq and Vietnam were truly to revalue their currencies at the levels suggested, the ripple effects could be enormous. Importers and exporters would see contracts recalculated, remittance flows would shift, and foreign debt obligations could be restructured overnight. Nations that conduct significant trade with Iraq and Vietnam would need to reassess their strategies, and multinational corporations operating in the region would be forced to rewrite balance sheets. The speculative fervor is therefore not confined to small investor circles. It represents a potential systemic event that could alter currency flows at a global scale. This is why the credibility of the information becomes so important. Without confirmation from the Central Bank of Iraq or the State Bank of Vietnam, everything remains speculative. Investors and policymakers alike are left to navigate a fog of uncertainty, where hope for gains clashes with the memory of past disappointments. Transparency and official communication will ultimately determine whether this moment becomes a true turning point in financial history or just another chapter in the long narrative of dinar and dong speculation. The human side of this story should not be overlooked either. In Iraq, ordinary citizens have endured decades of instability and would welcome a stronger currency that restores purchasing power and national pride. In Vietnam, a revaluation could reinforce the sense of progress that has defined the country's rapid industrial growth and expanding global role. For individuals in both countries, the promise of a stronger national currency is not simply a financial calculation. It is tied to identity, sovereignty, and hope for a more prosperous future. For now, global markets continue to react in real time, balancing skepticism with anticipation. Investors pore over unofficial reports, search for confirmation, and adjust strategies to prepare for both best and worst-case scenarios. What began as a rumor has escalated into a global conversation, one that underscores just how interconnected the modern financial system has become, and how even the possibility of change in two emerging market currencies can command worldwide attention. Thus far, the global financial conversation surrounding the revaluation of the Iraqi dinar and Vietnamese dong has been fueled not by concrete announcements, but by speculation, scattered reports, and the ripple effects of rumors. The absence of official confirmation from the Central Bank of Iraq and the State Bank of Vietnam has created a vacuum in which speculation thrives, magnifying uncertainty and fanning a cycle of both excitement and caution. Markets are particularly sensitive to signals of credibility, and without explicit acknowledgement from recognized authorities, traders, investors, and analysts are left attempting to interpret fragmented information. This dynamic illustrates how the lack of official confirmation often becomes as important as the rumor itself, because silence from policymakers forces participants to assign their own interpretations to ambiguous signals, creating waves of volatility. In the case of the Iraqi dinar, the idea of revaluation has circulated for years, often connected to Iraq's vast oil reserves and potential for economic reform. Yet every instance of supposed imminent revaluation has ultimately collapsed under scrutiny when official channels failed to provide confirmation. This history of unfulfilled expectations has made investors wary, though not deterred, because each new rumor seems to carry with it the possibility that this time is different. The Vietnamese dong, by contrast, has not historically been the center of such speculation to the same degree, but its role as a rapidly industrializing economy in Southeast Asia adds a layer of plausibility that heightens the intensity of current discussions. Without confirmation, however, even plausible narratives remain only that narratives that can drive behavior but cannot establish reality. The absence of official statements creates a particular type of financial limbo. Retail investors scour unofficial exchange listings and broker screens for anomalies, interpreting minor shifts as proof of deeper structural changes, while institutional players hesitate to move decisively without regulatory certainty. This gap between grassroots speculation and institutional caution leads to uneven market behavior. Small traders may rush into positions in anticipation of profit, but larger entities bound by compliance and risk protocols must wait for clarity. As a result, liquidity may spike in certain pockets of the market while remaining stagnant in others, producing distortions that are difficult to manage. The problem with unverified information in the currency market is that it creates feedback loops. A rumor spreads, traders act on it, price anomalies emerge, and those anomalies are then cited as evidence that the rumor is true. In the absence of confirmation, this circular logic can spiral quickly, creating bubbles that are disconnected from underlying fundamentals. Central banks, by withholding confirmation or denial, may inadvertently contribute to this cycle. Their silence could be strategic, designed to avoid prematurely influencing markets, or it could simply reflect the fact that no policy change is in motion. But for investors, The absence of clear communication often appears indistinguishable from implicit acknowledgement, leading to further speculation. For global markets, confirmation matters because it dictates whether adjustments are temporary or structural. If Iraq's central bank were to formally announce a revaluation of the dinar, the implications would cascade across oil contracts, import-export agreements, and bilateral trade settlements. Similarly, an official revaluation of the Vietnamese dong would affect manufacturing competitiveness, regional supply chains, and debt obligations. In the absence of such confirmation, however, global players cannot reprice these contracts with confidence. As a result, they may engage only in limited hedging, cautious repositioning, or speculative activity rather than the sweeping adjustments that would accompany certainty. The lack of confirmation also has geopolitical consequences. Iraq and Vietnam both occupy important positions in their respective regions, and sudden currency changes would send signals not only to markets but to neighboring states and global institutions. For Iraq, a revaluation could be read as an assertion of economic sovereignty and stability after decades of turmoil, while for Vietnam it could signal the country's readiness to move into a new tier of economic influence. Until official statements are made, however, these interpretations remain speculative, and governments and multinational corporations alike are reluctant to anchor policies to conjecture. One must also consider the psychological dimensions of this dynamic. The allure of overnight wealth generation through currency revaluation has been a powerful narrative in certain investor communities, especially with regard to the dinar. Social media platforms and informal investment networks amplify this narrative, creating an atmosphere in which hope often overshadows caution. The lack of confirmation paradoxically strengthens this dynamic, because believers can argue that the silence of authorities is part of a grand strategy or that confirmation is being deliberately withheld until the right moment. This interpretive flexibility makes rumors resilient, persisting even in the face of contradictory evidence. The Vietnamese dong adds another layer of complexity because of Vietnam's tangible economic progress. Investors can point to real indicators, manufacturing growth, foreign investment inflows, and trade surpluses as justification for the idea that a stronger dong could be on the horizon. This plausibility gives current speculation more weight than the purely rumor-driven cycles that have often characterized dinar conversations. Yet even here, the absence of confirmation keeps the market suspended between belief and doubt, unable to transition from narrative to fact. Regulatory bodies around the world have long warned investors about the dangers of speculation in unconfirmed revaluation scenarios. These warnings are rooted in the recognition that, without official announcements, there is no mechanism to guarantee access to revalued currencies at rumored rates. Even if a revaluation were to occur, it could be implemented in ways that privilege institutions or state actors, leaving retail investors unable to realize the gains they anticipated. This structural risk is magnified in the current situation because both Iraq and Vietnam maintain significant state control over their financial systems. In this context, the absence of confirmation serves as both a shield and a destabilizer. It shields authorities from prematurely committing to policies or creating expectations they cannot fulfill, but it destabilizes markets by leaving space for speculation to dominate discourse. Investors are forced to operate in this tension, balancing the lure of potential profit against the risks of chasing unverified information. The result is heightened volatility, fragmented trading activity, and a global conversation that grows louder precisely because no one in authority has spoken clearly. The history of the Iraqi dinar is one filled with speculation, myths, and repeated cycles of hope and disappointment. For decades, the idea that the dinar would suddenly and dramatically revalue has been a powerful narrative among certain investor communities, often drawing in individuals with promises of life-changing wealth. This backdrop of speculation has been so persistent that it has attracted the attention of regulators and consumer protection agencies worldwide. They have issued repeated warnings that claims of overnight revaluation are often tied to scams, misinformation, or unfounded optimism, and yet the cycle continues to renew itself with each new rumor. To understand the current wave of attention surrounding the dinar and its pairing with speculation about the Vietnamese dong, it is necessary to trace this history and examine why the risks remain so significant, despite years of warnings. Following the US-led invasion of Iraq in 2003, the country's currency system underwent massive restructuring. The Central Bank of Iraq introduced a new series of dinar notes, replacing the old Saddam-era currency that had been plagued by counterfeiting and instability. At the time, the new dinar was pegged at values that reflected Iraq's economic and political conditions, with exchange rates largely determined by oil revenues and foreign reserves. Yet even then, narratives emerged among foreign investors that Iraq's vast natural resources, particularly its oil reserves, meant that the dinar was artificially undervalued. From this belief grew the theory that one day Iraq would revalue its currency upward to reflect its true worth, creating immense gains for anyone who had stockpiled dinar at the lower exchange rates. This idea found fertile ground among retail investors, particularly in the United States, where online forums, newsletters, and later social media platforms promoted the concept of a future RV or revaluation. Sellers of physical dinar banknotes and related investment schemes capitalized on the hype, persuading buyers that they could secure a fortune by holding on to currency that would soon skyrocket in value. The problem, however, was that there was little to no basis for such claims. Iraq's central bank consistently maintained its control over monetary policy, adjusting the dinar gradually and in line with broader economic reforms, rather than through sudden leaps in value. Over the years, regulators such as the U.S. Commodity Futures Trading Commission, CFTC, and state attorneys general began issuing consumer advisories. They warned that promises of imminent revaluation were often fraudulent, designed to lure unsuspecting individuals into purchasing dinar at inflated premiums or into joining investment schemes that offered no guarantees. Despite these warnings, the allure persisted. The combination of Iraq's oil wealth and the lingering idea that post-conflict reconstruction would unlock rapid economic growth made the narrative resilient. Each new rumor, whether tied to changes in oil prices, political developments, or banking reforms, reinvigorated belief in the possibility of an RV. The risks tied to this history are not limited to financial losses for small investors. On a macro level, speculative attention around the dinar has sometimes distorted perceptions of Iraq's real economic progress. Instead of focusing on structural reforms, trade diversification, or improvements in governance, discussions often circle back to the supposed inevitability of a massive revaluation. This has had the effect of overshadowing more nuanced conversations about Iraq's fiscal stability, the challenges of corruption, and the volatility of its oil-dependent revenue base. By tying expectations of prosperity to a speculative event that never materializes, communities of investors and even some Iraqis themselves have found their hopes continually raised and dashed. The Vietnamese dong has more recently become entangled in similar speculative narratives. While it has not been the subject of scams to the same extent as the dinar, the growing attention reflects how these cycles can spread from one currency to another. Vietnam's strong economic growth, increasing role in global manufacturing, and rising foreign direct investment make it an appealing candidate for currency appreciation in the eyes of many investors. Yet the leap from appreciation to sudden revaluation is substantial, and without concrete announcements from the State Bank of Vietnam, the rumors remain just that. Here again, the absence of confirmation provides fertile ground for speculative interpretation, echoing the same pattern that has long characterized the dinar. The persistent risks in both cases come from the combination of speculative hope and the vulnerability of retail investors. Many individuals who participate in dinar or dong speculation are not seasoned traders. They are everyday people drawn in by the promise of extraordinary returns. This creates a fertile market for fraudsters who can exploit the lack of financial literacy, selling currency at inflated margins, charging fees for special access to revalued exchange rates, or promoting investment clubs that promise insider knowledge. Regulatory warnings have made clear that once money is lost in these schemes, it is often difficult, if not impossible, to recover. Another layer of risk comes from the psychology of belief. Even when confronted with evidence that revaluation rumors are unfounded, many investors continue to hold on to their dinar or dong, convinced that patience will eventually yield results. This belief is often reinforced by online communities where anecdotal stories and selective readings of news are used to sustain optimism. In this way, the speculation becomes self-sustaining, less about financial fundamentals and more about collective conviction. Such dynamics are difficult to disrupt, as they rely on hope rather than data. While the possibility of currency reform is never entirely out of the question for any nation, the history of dinar speculation shows that dramatic overnight revaluations are unlikely, and that claims suggesting otherwise should be treated with skepticism. Currency values are typically adjusted gradually and in accordance with macroeconomic conditions, trade balances, and monetary policy objectives. Sudden leaps are rare and usually tied to extraordinary circumstances, such as the adoption of a new currency altogether or the resolution of hyperinflationary crises. Iraq, while rich in resources, has not signaled any intention to pursue such an abrupt move, and Vietnam's gradualist approach to economic management similarly points toward incremental adjustments rather than seismic shifts. The lessons of the past therefore remain highly relevant in the present. The Iraqi dinar has been the subject of waves of speculation that have enriched a few sellers but left many investors disappointed. The Vietnamese dong, now caught up in similar conversations, risks being used in the same way by opportunists who understand how to market the dream of sudden prosperity. These cycles reveal the dangers of relying on unverified claims and highlight the ongoing need for investors to exercise caution, consult credible sources, and remember that in global finance, there are rarely shortcuts to wealth that come without equally significant risks. Key factors to monitor in the ongoing speculation around the Iraqi dinar and Vietnamese dong revolve around the credibility of information, the transparency of mechanisms for exchange, and the underlying economic fundamentals that would either support or undermine any potential revaluation. The most critical of these is the question of whether official confirmation will ever emerge from the Central Bank of Iraq or the State Bank of Vietnam. Without such confirmation, the market is left navigating rumors, leaks, and fragmented data that create uncertainty rather than clarity. Investors know that central banks are the only authorities capable of implementing such sweeping monetary shifts, and until they speak directly, every other signal is speculative. The credibility of the issuing authority becomes the foundation on which investor confidence must be built, and in global markets, confidence is as valuable as capital. When institutions remain silent, that silence itself becomes subject to interpretation, often leading traders and retail speculators to assume intentional secrecy rather than the more likely explanation of inaction. Another element to watch is access and transparency, both of which are decisive in determining who benefits from any potential revaluation. In most cases where currencies undergo adjustments, governments and central banks impose strict controls on how those changes are rolled out, often limiting availability to domestic banks or prioritizing institutional investors. Retail holders of the Iraqi dinar and Vietnamese dong frequently assume that they will be able to walk into local banks or exchange houses and trade their currency at the newly revalued rate. But history shows that access is rarely this simple. Governments may restrict exchanges to domestic citizens, implement gradual rollouts, or establish differential rates for official versus open net transactions. Transparency in how the revaluation would be managed, therefore, becomes just as important as the revaluation itself, because without clear mechanisms, ordinary investors may find themselves excluded from the benefits they anticipated. Sustainability is another crucial dimension. Even if a dramatic revaluation were announced, the durability of that move would depend entirely on whether economic fundamentals could support it. Iraq's fiscal health remains deeply tied to oil exports, leaving it vulnerable to global price fluctuations. Its public debt, governance challenges, and reliance on imports all complicate the case for sustaining a stronger dinar. Similarly, while Vietnam has achieved remarkable growth as a manufacturing hub, it still faces challenges in managing inflation, maintaining currency stability, and balancing its trade accounts. A sudden leap in the dong's value could undermine its export competitiveness, eroding one of the very foundations of its economic success. Sustainable revaluation would therefore require careful coordination of monetary policy, trade policy, and fiscal discipline, none of which can be achieved overnight. Beyond domestic considerations, the international environment must also be monitored. Currency values are not determined in isolation, but in relation to global flows of capital, trade, and geopolitical dynamics. For Iraq, the role of the US dollar in oil contracts, the influence of the International Monetary Fund, and the pressures of regional politics all weigh heavily on what is possible. For Vietnam, integration into trade agreements, relationships with partners such as the United States and China, and the broader health of global manufacturing supply chains play decisive roles. If either nation were to pursue a revaluation, the reaction of international markets and institutions would be swift and decisive, and sustaining credibility would require alignment with global expectations. Market infrastructure itself becomes another key factor. Investors must consider whether the domestic banking systems of Iraq and Vietnam are robust enough to handle the surges of demand and liquidity that would accompany a revaluation. Exchange systems, clearing mechanisms, and compliance structures would all be tested in ways they have not been before. Without strong infrastructure, even an officially declared revaluation could descend into chaos, with conflicting rates, long delays, and the emergence of black market alternatives, undermining the credibility of the move. Watching how both countries prepare their financial infrastructure through reforms, modernization, or the adoption of international standards provides important clues about whether a large-scale adjustment is even feasible. The human element also deserves close monitoring. For Iraqi and Vietnamese citizens, the stakes of revaluation are not abstract financial calculations, but matters of daily livelihood. A stronger currency could increase purchasing power, reduce the cost of imports, and create a sense of national pride, but if mishandled, it could also lead to inflationary spikes, distortions in local markets, or worsening inequality. Policymakers must weigh the domestic consequences of such a move carefully, as public sentiment can quickly turn from celebration to discontent if expectations are not met. Observing government communication, social narratives, and citizen responses provides insight into whether the political environment is prepared for such a shock. Speculators often focus narrowly on the rate itself, how many US dollars a dinar or dong might be worth after revaluation, but the broader picture involves a complex web of factors that must align to make such a shift realistic. These include fiscal reserves to defend the new rate, trade balances that support a stronger currency, and international confidence that prevents capital flight. Watching how Iraq and Vietnam manage these variables in the coming months and years is essential for distinguishing hype from genuine possibility. Another consideration is the role of regulatory oversight in countries where speculative interest in these currencies is strongest, particularly in the United States and Europe. Authorities in these regions have a history of issuing warnings about dinar scams, and a response to the latest wave of speculation will be telling. Regulators intensify scrutiny, crack down on fraudulent schemes, or issue updated advisories. It will signal that the risks to retail investors remain high. Monitoring these developments helps clarify whether the speculation is seen as a legitimate market movement or simply another round of unverified hype. Finally, one must watch for the interplay between rumor and market psychology. In situations like this, perception often drives behavior just as strongly as reality. If enough investors believe a revaluation is imminent, they may act in ways that create temporary price anomalies, which are then cited as proof of the original rumor. This self-reinforcing cycle can persist until it is either validated or collapsed by official action. The dynamic nature of speculation means that the absence of clarity continues to fuel waves of activity, leaving markets volatile and participants divided between optimism and skepticism.